Hi there. Now, many investors are concerned about the US economy entering a recession. This is relevant since that most risk assets perform poorly during recessions and investors need to take a much more defensive approach in asset allocation. Now, let's start with looking back at previous recessions, and there are several observations. First, the last two recessions, the global financial crisis in 2008 and the COVID-19 pandemic in 2020, were particularly severe. Even though we can't accurately predict the trigger of the next downturn, a more conventional recession should be less painful for households and companies. Second, most recessions have seen private investment contracts more than personal consumption, especially in inventory correction. Hence, it is important to consider corporate sentiment in capital spending and hiring. Now, what are some of the potential weak spots in the US economy? There are several areas where the US economy is showing signs of overheating. Unemployment rate is at a multi-decade low, leading to strong wage growth. This could also pressure the Federal Reserve to raise interest rates more aggressively in order to cool down the economy. Now, back to the corporate sector. Corporate sentiment is obviously an important gauge, and we have seen some cooling on the Institute for Supply Management's Manufacturing New Orders Index, indicating some slowdown in corporate spending. We'll continue to monitor whether tighter monetary policy, both in terms of high policy rates and quantitative tightening, would push corporate borrowing costs higher and force companies to cut back on spending. Overall, there are some signals that the US economy is moderating with more cautious corporate sentiment and investment, as well as inventory destocking. As the US economy is in the process of transitioning from the mid part of the growth cycle to the late part, investors can adopt a more balanced allocation between equities and fixed income. The painful adjustment since the start of the year probably has partly factored in economic slowdown. We'll also expect quality companies with a strong balance sheet and pricing power will be able to withstand rising costs and higher rates. It should be noted that risk assets can still deliver positive return in the late phase of the economic cycle. The surge in US Treasury yields in the past year means that government bonds can once again play an important role in portfolio construction. The current yield level should start to look attractive to investors that are looking for low volatility to generate income.